Let me teach you how to invest the right way. Now, before you click off thinking, here comes another course, I want to show you something we've all seen online. Are these entertaining? Absolutely. Educational? I mean, yeah, for the wrong reasons. The truth is, most people lose money because they've never learned the fundamentals of investing. This video fixes that. Today, I'm going to walk you through the entire foundational framework of investing, from the basics to stocks and bonds, to diversification, portfolio construction, efficient markets, fees, and even what I personally invest in. By the end, you'll understand exactly how to build a long-term, diversified portfolio that actually grows your wealth without gambling, guessing, or YOLOing options. With that in mind, let's get into it. To start off, I want you guys to remember these 5 core ideas. Even if you click off the video or if you forget everything else in the video, just remember these 5 principles. Number 1, diversify, diversify, and for good measure, diversify. Diversification reduces the risk that any single company, industry, or country ruins your portfolio. It is the closest thing to a free lunch in finance. Number 2, start investing yesterday. If you didn't start yesterday, the second best time is today. The earlier you start investing, the more compounding and time in the market work for you. Don't try to time the market. Start now. Dollar cost average if you're nervous. Time is the single most powerful variable you control. Number 3, don't try to beat the market. Financial markets are mostly efficient. Most professionals can't beat the market consistently, so why should you try? For most investors, passive investing beats the complexity and cost of trying to be right all the time. Number 4, watch your fees. Fees are a guaranteed drag on returns and compound against you. Prefer low-cost vehicles unless you have a clear, evidence-based reason to pay more. Where these fees show up, it's in the form of expense ratios, trading commissions, bid-ask spreads, and taxes on capital gains or dividends. And number 5, think about what matters for your portfolio. The key personal variables that matter are your risk aversion, the investment horizon, your background risk, and the investment style and preferences that you have and want to reflect in the things that you're investing in. Okay, now let's get into the meat of it all. And let's start off with bonds. So a bond is a loan. You, the investor, lend money to the issuer. Issuers include the US Treasury, municipalities, corporations, or foreign governments. In return, they promise fixed future payments, usually interest plus repayment at maturity. Bonds can be incredibly useful for portfolios, but the market can be complex with things like yield curves, credit risk, duration, interest rate risk, inflation risk, and a lot more other things. If you want to go deeper, I definitely recommend studying them more. This video will be focusing more on the fundamentals and even more on equities. Now, stocks. So stocks represent ownership in a company. You own a fraction of the issuing corporation. You're entitled to potential dividends and price appreciation. You also may get voting rights, and you're last in line to get paid out in the case of a bankruptcy. Stocks don't promise fixed payments like bonds, but historically, they've delivered much higher returns because they come with higher risk. This is the asset class in which most people are invested. Here is a summary of returns for the S&P 500, including dividends and different bonds. As we can see, equities have far outperformed because they are more riskier. The 3-month T-bill is what's considered to be the risk-free rate in finance because it's backed by the US Treasury, which is considered to be the safest investment in the world. Then we have the BAA corporate bonds, which are companies with moderate default risk and are considered to be the benchmark for investment-grade corporate bond risk. So, diversification. We've all heard this term, and it's one of the most important concepts of investing. Here I'll show you what the fundamentals and theory behind it is. The key driver of portfolio risk is the correlation between the assets. This is essentially how two assets co-move with each other. A positive correlation would mean that when asset A goes up, so does asset B, for example, different tech stocks. And a negative correlation would be vice versa, for example, gold versus stocks. And this concept is the underlying basis of diversification. Correlation is a standardized measure of co-movement of two or more assets ranging from -1 to +1. A correlation of +1 means that the assets move perfectly together. A correlation of 0 means that they move independently from each other. And a correlation of -1 means that they are perfect opposites. If you have two assets, assets A and B, with their own respective weights and standard deviations, and you have the correlation between the two, you can get this formula for the portfolio variance, or the measure of risk of the portfolio based on how much its returns fluctuate. This first term here is the risk contribution of asset A alone. The second is the risk contribution of asset B alone. And the third term measures the interaction between the two. So how asset A and B move together. If they move together, so they have a positive correlation, then the term adds risk to the overall portfolio. If they move opposite to each other, so negative correlation, then it subtracts risk from the overall portfolio. Diversification benefits come from correlations less than 1. So the lower the correlation, the bigger the diversification boost. To visualize this impact of diversification, let's assume we have an infinite number of stocks in an equally weighted portfolio, which means each weight is equal to 1 over n. Let's assume that these are all independent or uncorrelated stocks, which means the correlation is 0. With that assumption in mind, and through a bunch of algebra, we get this formula from the portfolio variance formula. Since the correlation is 0, this term on the right is also now 0. Now say we increase the number of assets to infinity. As we get to infinity, this portion of the equation gets closer and closer to 0, which means we have actually fully diversified away any risk in the portfolio. This is the idiosyncratic risk or asset-specific risk. Now, let's assume we, again, have an infinite number of stocks, but now they are all interdependent or correlated stocks, which is obviously more realistic. Same idea, as n goes to infinity, this part of the equation goes to 0. But now, since the correlation is not 0, what we are left with at the end is the average covariance as the risk of the portfolio, which is non-diversifiable. This is also called systematic risk, or the risk that comes from the market itself. Total risk of a portfolio is equal to the idiosyncratic risk plus the systematic risk. Idiosyncratic risk is risk specific to an individual asset, company, or sector. This could be poor management decisions, scandals, regulatory changes affecting just one industry and more. Investors can mitigate this risk by having a diversified portfolio across many assets, as we've just seen. Systematic risk, on the other hand, is risk inherent to the entire market or financial system that cannot be avoided regardless of how diversified a portfolio is. This could be economic recessions, monetary policy, inflation rates, geopolitical events, among other things. Since idiosyncratic risk can be diversified away, understand that financial markets will only compensate you for systematic risk, which means under-diversifying takes unnecessary risk. As an investor, you cannot expect higher returns for that extra risk. Naturally leads us to a bigger question. If markets only award systematic market-wide risk, then who decides what the right compensation for that risk is? The answer lies in how markets process information. Every second, millions of investors react to earnings announcements, macroeconomic data, geopolitical news, and their collective trading adjusts the prices of the markets until no one has a consistent edge. This brings us to the efficient market hypothesis, that markets are efficient and prices reflect all publicly available information about an asset's value. If markets weren't efficient, investors would constantly find information that wasn't yet reflected in stock prices. They would use that information to buy undervalued stocks and sell overvalued ones, earning easy profits. But as more and more investors act upon that information, their trades would quickly push prices up or down until the mispricing disappeared. Implications are that price changes and future returns are unpredictable. Since returns are not correlated over time, stock prices follow random walk, and simple trading rules based on past prices just don't work. Essentially, you cannot earn higher returns by picking good investments. So, am I telling you that it's possible to predict prices with information unavailable to others? Yes, this would give you an edge, but it's also considered to be insider trading and is illegal. Now, this brings us to looking at different investment styles. First, we have stock picking. This is where investors invest in individual stocks based on their research or beliefs of what will outperform in the future. Stock picking forgoes benefits of diversification, and as we've just discussed, means that you end up holding risk which is not compensated for with higher returns. Then you have active investing, which is where investors select a subset of assets in a given class with the aim of earning higher returns than the average. More often than not, active investment funds do not outperform their individual benchmarks. Here's a chart that shows the percentage of funds that underperform their individual benchmark by strategy. And it's very clear to see that on average, 80% of funds, if not more, underperform their individual benchmark across different time horizons. Now, you may ask, since it's around 80%, does that mean that there are some funds who do outperform? And what if I go out, find those fund managers that are skilled and can outperform consistently? This graph now illustrates the percentage of top half actively managed domestic equity funds consistently remaining in the top half over a 5-year period. Only 2% of large cap equity funds remained in the top half over a 5-year period. Mathematically, the expected percentage of funds should be 6.25% under a random distribution. So the fact that this is below that is pretty clear evidence that outperformance, when it occurs, tends to be the result of luck rather than genuine skill. So then why do people still buy active funds? It's survivorship bias. Funds close when they underperform, and as a result, only the lucky funds are the ones that are left. The past performance of this lucky fund looks good, but as we know, past performance is not a good indicator of future performance. And then finally, we have passive investing, which is where you just buy and hold a diversified portfolio within an asset class, and as a result, are able to minimize costs and take any guessing out of the mix. This is the best form of investing for 99.9% of people. So now the question is, why do these active funds underperform? Turns out, on average, active funds actually do end up beating their benchmarks because financial markets are not completely efficient. But after considering cost and fees, almost all of them end up underperforming. So is it possible to beat the market? Yes. Do investors benefit? Absolutely not. Here's a table that shows the excess return by fund type. And clearly, based on this table, the best thing for investors to do is passive investing, since all that is happening is that you are buying the index and holding, resulting in minimal trading costs or expenses, whereas active investing requires more frequent trading. Minimizing fees and trading costs are critical to long-term investing. Let's take this example scenario where we have 3 different investors, and all of them are starting out with $10,000 invested, and over 30 years, invest $100 every week. I think this is a pretty fair amount for the average person, although in most cases, people actually do end up investing more. But for the sake of this exercise, let's continue. They all took my advice about diversification and bought diversified ETFs that track the S&P 500, but only investor A ended up watching the video long enough to reach this part. So with this advice in mind, investor A invested in an ETF with an expense ratio of 0.03%, investor B in an ETF with an expense ratio of 0.5%, and C in an ETF with an expense ratio of 1%. After 30 years, they compare their portfolios and see this. Investor A has significantly more money than B or C, but how? They all invested in the same thing. They all invested in the S&P 500. The return should have been the same. Turns out, it was those fees all along. Investor A ended up with almost $125,000 more than C, even though they all did the exact same thing. Here's a list of passive funds tracking the S&P 500. And even though they're all tracking the same underlying index, which means that they all have the same gross returns, some charge a significantly higher expense ratios than others. meaning the net return can actually differ by quite a lot. So do your research and make sure you minimize your fees as much as possible. Choosing your investments should be a very personal decision. It should be tailored to you, and it should be something that fits your goals. So there are 4 things to consider. The first one being your risk aversion. Use questionnaires or simulate drawdowns to understand your risk tolerance. And depending on your risk aversion, you can then choose more or less risky portfolios for higher or lower expected returns. The second thing is your investment horizon. You have to map your goals to time. If you have a short-term horizon, maybe you should stick with cash or short-term bonds. A medium term, maybe do a mix of bonds and equities. Long term, maybe you prefer tilting to equity so you can ride out those short-term fluctuations. The third thing is your background risk. If income is volatile, for example, you're doing a freelance job or a cyclical job, you should prioritize liquidity and safer allocations so you have something to fall back on when you aren't actually earning a wage. And then finally is your personal investment style and preferences. Choose passive if you want simplicity, or add factors or small active positions if you have conviction, discipline, and experience. Now that we got all the theory, tips, and advice out of the way, this is what my portfolio looks like as of December 5th, 2025. So I have 92.4% of my portfolio in VOO, which is Vanguard's S&P 500 ETF. It's low cost, has a 0.03% expense ratio. It has broad US exposure and has historically strong returns. I'm primarily invested in this because it aligns with my core passive investing philosophy. Then I have 4.5% of my portfolio in FBDC, or Fidelity's Bitcoin ETF. This is my small risky allocation. It has very high volatility, but I put in a small allocation because of the potential for asymmetric returns. I bought the ETF because I actually never had the chance to learn about how crypto trading works or how things like cold wallets work. So here I am paying a 0.25% expense ratio on this ETF, and ideally should not be if I had just used a cold wallet. And then finally, I have 3.1% of my portfolio in DFSV, which is Dimensional Fund Advisor's Small Cap Value ETF. And this is my dedicated small cap exposure with an expense ratio of 0.3%. So the rationale behind this is that, in theory, small cap stocks should actually provide higher long-term returns because they're riskier. And as we've learned, investors need to be compensated for that additional risk. But for over a decade now, that hasn't played out. Large caps like the Mag 7 have massively outperformed small caps. And there are several reasons for this, including how there have been many low quality, so pre-profit and even pre-revenue companies that have been going public in the past few years, which has resulted in the entire market punishing all small caps. And on top of that, many of the best small cap companies have opted to stay private, whether that be to avoid all the burdens that come with being a public company, or because of a low interest rate environment and ample dry powder in private equity, resulting in them not actually needing to go public to access more capital. I'll link a resource down below by Wellington Management, which actually explains all of this pretty well. Now, one thing to note is that DFSB is actually actively managed, and this does go against the passive investing advice I've given in this video. But the reason I choose DFSB is because I don't want blanket exposure to the entire small cap universe, given the number of bad companies. DFSB focuses specifically on profitability, value-oriented small cap companies, which actually aligns better with the academic evidence and my personal investing preferences. For the future, I actually plan on adding another investment, another ETF, being VXUS, which is Vanguard's total international stock market, excluding the US. This helps me reduce home country bias and gets me some global exposure. Staying invested in just the US means that I am relying entirely on US outperformance, essentially believing that the US stock market will continue to perform as well as it has been. I'm slowly starting to not maintain that same conviction. And when looking at globally at emerging and developed markets like India or China and how they've been progressing, I'd actually like to get some exposure there. Now, keep in mind that this portfolio works for me. I'm young, I have a long investment horizon, can tolerate short-term fluctuations and be more risk-taking. Your portfolio should reflect you as a person and your goals. What should you be doing after you've watched this video? Number 1, open an account with a reputable broker. Vanguard, Fidelity, Charles Schwab, whatever you prefer. Second, choose your investments, ideally using the principles we covered today. Third, decide your asset allocation based on your risk tolerance, time horizon, and financial goals. Fourth, automate your contributions monthly or every paycheck or whatever works for you, so investing becomes effortless. And then finally, be tax efficient. Use tax advantage accounts where possible and place tax inefficient funds in those accounts to reduce how much you lose to taxes. Let me know if you guys would actually like a separate video on the different accounts like 401ks, HSAs, Roth IRAs, and all of the other things that are important when thinking of saving for retirement. With that said, thank you so much for watching. I hope this video helped simplify investing while also teaching you about the theory behind it all. I would love for you all to drop any questions, insights, or critiques you have down below in the comments, and I'd love to talk with every single one of you. In the meantime, go out there and take control of your financial future, and I'll see you all in the next one.